Howdy, Hot Shots. Dividend Daddy here, your favorite not a financial advisor with not financial advice. I'm here to tell you 3 ways that you can buy ULTY cheaper, or any other stock for that matter. So we have been talking about covered calls and cash covered puts because we're dealing with a covered call ETF, and a covered call and a cash covered put are basically equivalent. They're just different strike prices relative to the underlying stock's value. So you can utilize these tools in order to get a discount on your shares. And if you've been reading through the comments, you'll see that some people are already doing this. I've been doing this for a long time, 15 or 20 years. I almost never just go out and buy an individual stock. You can either sell a put and get a discount, and I'll give you an example here in a minute. You can sell a call and get a discount, okay? So there's different ways that you can do that. If you have a stock that is trading around $6, like ULTY's right now $5.75, but I just want to use some round numbers. If you have a stock that's trading at $6 and you sell a $6 cash covered put, meaning you're agreeing to buy 100 shares of that stock for $6, you may be able to get a 25-cent premium for that. So for each contract, you would get $25 because a contract for options is 100 shares. So you have to multiply everything by 100. So if you have a $6 strike price, you multiply it by 100. If you have a 25-cent premium, you multiply it by 100. So a $6 strike put with a 25-cent premium would cost you $600 to enter the position once that put is assigned to you, and it pays you $25, essentially meaning that you have a cost basis of $5.75 on that stock. So if you want ULTY and it's trading at $6 and you sell a $6 put, once that gets assigned to you, if you've got a 25-cent credit, your cost basis is essentially $5.75. Now here's another trick. If you want to make sure that you are getting assigned the shares and you want to participate in some upside, all right? Because if you sell a $6 strike put and the stock goes to $6.25, you're not going to get assigned the shares. You also don't make the 25 cents in the $6 to $6.25 growth. You can sell a higher strike put. So let's say the stock is trading at $6 and you sell a $7 strike put. That put is already in the money when you sell it. Maybe you can get $1.15 in credit for that share. So now you're agreeing to pay $700 for 100 shares of that stock, but you're getting $115 credit. So your cost basis is $6.85. Assuming the stock doesn't go on some meteoric rise before your option expiration date, you're going to be assigned those shares and you're going to pay $700 for those 100 shares. But you've gotten your $1.15 credit, so now your cost basis is $6.85. Now, if the stock during that time period went from $6 to $6.50, you participated in that gain because now when you buy your shares for $7, they're already worth $6.50. On the flip side, if the stock goes down to $5.50, then you have lost $50. Your cost basis is $6.85 minus this $5.50. You're looking at a 35-cent loss at that point, so $35. So you have cushioned your downside. You have participated in potential upside growth, okay? And you've gotten a discount compared to where the stock was trading the day that you entered the trade. So that gives you 3 potential benefits, right? Another way to do this, because we set a put, a cash covered put, and a covered call are essentially the same vehicle, okay? It's just implemented differently. If you buy the shares for $5.75, but then you can sell a $6 covered call, that means as long as your stock doesn't go up above $6 before expiration, you'll get to keep your shares. But you collect a credit, a premium for selling that option. So let's say you can buy the shares for $5.75. So you buy 100 shares of ULTY or any other stock for $5.75. Now you sell a $6 covered call and you get a 10-cent credit for that. Well, you have limited your upside potential to between $5.75 and $6, because anything above that prior to expiration, and you risk having the option assigned to you, which means they will buy your shares for the $6, or at expiration, it will probably be automatically exercised, meaning they will buy your shares for $6. So you have limited your potential gain to anything beyond $6. You're not going to make any gains if the thing goes above $6, more than you would have if it stopped at $6, because those belong to somebody else, the person who bought the option. But you still have upside potential because it can go from $5.75 to $6 and you have that gain. And you've also collected a premium. So if you paid $5.75 for the shares and then you sell a covered call at $6 a month out, you collect 10 cents. That brings your cost basis down to $5.65. Now, I'm not an accountant or a tax person, so that, it depends on what time frame you've held the stock for when you sell the covered call, how that is coded, whether it's income or a reduction in cost basis or short or long-term capital gains. But essentially, on paper, if you're just calculating your cost basis, you can reduce that by 10 cents. And so you can sell an out-of-the-money put, okay? And then if it goes down below that, then the shares are going to get put to you. But regardless, you get to keep the premium, which you could apply towards buying other shares of the stock if you don't get assigned. You can sell an in-the-money put, which gives you some potential upside, and additionally will give you a credit that will go towards the price of the stock as it trades today. You can sell a covered call, an out-of-the-money covered call, which gives you some potential for gain, and also gives you a credit, which reduces your cost on the stock. You can also sell an in-the-money covered call, okay, which I wouldn't necessarily recommend on ULTY, specifically because they may call your shares away in order to capture the dividend. But that's another way that you could get a discount. I'll get into that in a second. So an in-the-money covered call on a high-yielding stock, I feel like they may take your shares away unless there's time value. If there's a big premium on the time value, then they're not going to want to throw away their time value just to capture a one-time dividend. I have noticed in ULTY's option market that a lot of the offers for in-the-money calls add up with the strike price to less than the share prices. That means that if somebody decides to sell you that option, you automatically are in profit. So if you can purchase an in-the-money call option on a stock, and the premium plus the strike price is lower than the current price of the stock, depending on fees that your brokerage charges. Now, I don't have exercise fees and assignment fees and things like that, but depending on the fees that you're paying for those functions, if you could potentially buy an option and then exercise it immediately and get a discount on those shares. Okay, and that was the main thing that I wanted to talk to you about today, because I know a lot of you understand selling puts and selling covered calls, and those will get you premiums that can reduce your cost basis. But one thing you can think about when you're looking at options on a stock is if it's immediately in the money. Now, most of the time, those orders won't get filled, okay? But as we saw on Robinhood the other night with the flash crash in ULTY, the market is not always 100% efficient. It's pretty dang close. Most of the time, it is 100% efficient. But occasionally, you can sneak in and get a little bit of a deal. So if you see the opportunity to buy an in-the-money call option, and the strike price plus the premium is lower than the current stock price, you could potentially buy that option, exercise it immediately, and have gotten a discount on the shares. Okay, so let me know down below if you've ever done this, if you've ever thought about it, if you've ever tried and it just failed miserably. Please let me and everybody else know down below, and I'll talk to you degens later.